Ladies and gentlemen, I welcome you once again to I Am Academy. Today we are going to revise a past paper question. This is a revision class. We'll be revising a question on partnerships, further aspects of partnerships. A question that was examined in December 2014, question 2b. All right, I hope you have a copy. And I know by now you are aware that these past papers can be downloaded from our website free of charge. And I always encourage my students to participate in the learning process. So make sure you have a pen and a paper when you are doing calculations. You are also carrying out your calculations, confirming the figures, because that is very important in the process of learning. Your participation is required, is key. So we'll go straight into the question. I read it. Paul and Mary have been carrying on a partnership business for several years, sharing profits and losses in the ratio of 3:2 respectively, after allowing for a salary of 20 shillings per month to each partner and interest on partners' fixed capital at the rate of 10% per annum. The partners agreed to convert the partnership into a limited liability company known as Parma Limited on 1st April 2014 under the following terms. Number 1, goodwill to be valued at 4 million and be amortized for 4 years. The second term, the non-current assets to be taken over at the following values: buildings 30 million, furniture and fittings 10 million, motor vehicles 12 million. At another term, we are told each partner to be a director of the company, sharing a salary of 100,000 shillings per month, earning a salary of 100,000 shillings per month. Another term, each partner to be issued with ordinary shares equal to their capital contribution. The partners agreed to invite John to be a shareholder of the company on payment of 3 million. Then lastly, the financial year of the company would be 30th September, which was the same as that of the partnership being converted. The trial balance below was prepared for the year ended 30th September 2014 before adjustment to convert the partnership into a limited liability company. So we have a trial balance. There are 2 columns, debit balances, as you are aware. Then you also have credit balances. We have buildings, motor vehicles, furniture and fittings, accumulated depreciation, receivables and payables, prepayments and accruals, bank loan, bank balance, capital accounts, administrative expenses, distribution costs, accounting and auditing fees, finance cost, current accounts, gross profit, investments at cost. So those are the items. The figures are given in the table in thousands. Okay? Then below the table, we have additional information. The first additional information. Number 1, assume sales and expenses accrued evenly throughout the year. Number 2, there were no purchases or sales of non-current assets during the year. Depreciation is to be provided based on cost at the following annual rates: motor vehicles 15%, furniture and fittings 10%. Then the last additional information, we are told that the directors did not pay or propose dividends for the period ended 30th September 2014. Required: 1. Statement of comprehensive income for the year ended 30th September 2014, clearly showing how the profits were shared between the partnership and the company. Required 2. Statement of financial position of Pharma Limited as at 30th September 2014. So that is our question. That is the question. We need to revise. Remember, we are revising. We need to revise. We need to revise. It's a past paper question. And we'll go through the question once again, slowly, once again, identifying items, interpreting certain terms. We've been given terms. We've been given additional information. Then how we are going to treat, we decide how are we going to treat some of these transactions that we've been given in the question. It's very important. When an examination, don't just hurry to provide answers. Make sure you have understood the question. Here you are told Paul and Mary are partners. They have been carrying on partnership business for several years, and they were sharing profits and losses in the ratio 3:2. 3:2. Okay? So a partnership business, as you are well aware, is a business that comprises of partners, individuals who come together with the view of making profit. So they come together, they do business, they work as partners in a business, they register it as a business, and they come into agreement on how they are going to share profits, because the main purpose of coming up with a partnership is to make money, to make profit. So once they have agreed, they need to agree how they are going to share the profits. So Paul and Mary, they were sharing profits and losses in the ratio of 3:2 respectively. So it means Paul was getting a larger portion of the profit, and Mary was getting a smaller portion of the profit. Paul was taking home 3/5, while Mary was taking home 2/5. Okay? And the reason we can tell, if you check the trial balance, why is it that Paul was taking home a larger portion? It is because he had contributed 14 million from the table, and Mary had only 10 million. So that's why he's earning more, he's taking more. He contributed more in form of capital, okay? That's why he's earning more than Mary. Don't say he's manipulating Mary. No, there is no manipulation. The reason why he's getting more out of the profit is because he contributed more capital, all right? That's important. Then the second sentence, we are told, we are told, by the way, we are told they were getting this profit after allowing for a salary. Both partners were earning a salary of 20% per annum. Okay? And there was also an interest on capital at the rate of 10% per annum. Then you are told the partners decided to convert the partnership into a liability, limited liability company. The name of the company you are given, Pharma Limited. And the date is on April 20th, 14. The date is very important. You need to mark the date. The date, remember, an accounting period runs for a period of 12 months. But you see, Paul and Mary have decided to convert the partnership midway. You can see from 1st April to the accounting period, we are told the financial year of the company is 30th September. So you can see from 1st April 2014 to 30th September 2014, that's a period of 6 months. It means that the company has been in operation for 6 months, while the partnership was in operation for only 6 months also. Because remember, we are told, we are asked in the question to prepare a statement of comprehensive income for the year ended 30th September, clearly showing how the profits were shared between the partnership and the company. So that is very important. It's important to determine the date of conversion. When was it converted? Was it converted after 6 months? Was it converted after 3 months? Because that will determine how you are going to portion the sales or expenses or profits. As far as additional information number 1 is concerned, we are told assume sales and expenses accrued evenly throughout the year. So we need to determine the period under which the partnership was in operation and the period under which the company was in operation, so that sales and expenses can be apportioned on time basis. That one we have done. The partnership was in operation for 6 months. The company was in operation for 6 months. So we will apportion evenly. We will apportion evenly, and that will be 50% for partnership, 50% for the company. All right? Then another term we are told, goodwill to be valued at 4 million. Goodwill to be valued at 4 million. Goodwill is supposed to be enjoyed by the partners, by the former partners, by Mary and Paul. Mary and Paul. There is a goodwill here which we are told is also amortized. Goodwill, remember, is an asset. It is an asset that has arisen at the point of conversion. So Paul and Mary are supposed, the capital accounts of Paul and Mary should be credited with this goodwill. And we are told is being amortized over 4 years. This goodwill will not be written off. This goodwill will have to appear in the books of the company after conversion. It will not be written off. What will be written off will only be the amortized value, which will calculate. And it's simply 4 million divided by 4. So goodwill amortization for 1 year is 1 million. It's 1 million. Okay, that's important. Then you are told the non-current assets to be taken over at the following values. These are taken over values. So we'll at some point determine, was there revaluation gain or revaluation loss? If revaluation gain, then the capital accounts of the partners are supposed to be credited. If there is any loss, if there is any evaluation loss, then it means the partners are supposed to meet that loss by debiting their capital accounts. So revaluation is a capital gain. It increases that one is credited. It's credited in the capital accounts. Okay. Then the third term, we are told each partner to be a director of the company earning a salary of 100,000 shillings per month. So Paul and Mary will become directors, and they'll be earning 100,000 shillings per month. And you see that is an improvement. In the partnership, they are only earning 20,000 shillings per month. Now they are directors, okay, and they deserve directors. They are the ones directing the company, and they are the owners of the company at the same time. They are owners, shareholders, the main shareholders, who are also the directors of the company. They are taking home a cool 100,000 shillings per month. Then each partner to be issued, we are told each partner should be issued with ordinary shares equal to their capital contribution. Equal to their capital contribution. So at the date of conversion, we'll determine what are the capital balances of these partners. What are the capital balances after conversion? Once we have done that, we'll be able to convert these balances into ordinary share capital. That's what we are told. Issued with ordinary shares. The partners also agreed to invite John to be a shareholder of the company on payment of 3 million. John became the third shareholder, but under one condition, that he was supposed to pump into the company 3 million. Okay, that was the condition. Then that's it, we have it. Then we have the trial balance. Trial balance, we have the assets, we have liabilities, we have capital balances. So we need to now go into calculations. Now we have analyzed the question. We need now to calculate. We need to prepare. We need to prepare the statement of comprehensive income. Number one, statement of comprehensive income. Statement of comprehensive income. That's what we need to do. This question is we need to write the name of the year. It's December 2014, question 2b. December 2014. December 2014, question 2b. That's the question we are revising. Don't forget, we are going to revise that question. So we are supposed to prepare the comprehensive income statement. Comprehensive income statement. Comprehensive income statement for the year ended. The year ended. We are told that the year ends on what? The year end, the financial year of the company would be 30th September. 30th September for the year ended 30th September 2014. And we are told in the question, clearly showing. The question says, clearly showing how the profits were shared between the partnership and the company. So we have partnership. We'll have a column for partnership. And the company. Partnership and the company. We'll have separation, partnership and the company. Partnership and the company. Partnership 6 months, company 6 months. 6 months, 6 months. How the profits were shared. From the question we are given the profit, the gross profit from the question. These figures should be in thousands. From the question we are given the gross profit from the trial balance. We have the gross profit of 33,300,000. 33,300,000. So that gross profit is shared evenly. Gross profit is shared evenly, half. 33,300,000, half, divide by 2. For the partnership, 6,650,000, 16,650,000, half, evenly distributed. Then we deduct expenses. Do you have expenses from the question? Yes, administrative expenses. Just below the capital, as you can see from the question, administrative expenses is 3,800. Admin expenses. 3,800, divide that by 2. Even 1,900, we have 1,900 for partnership, 1,900 for the company. Any other expense from the question, you can see.